Hey guys, welcome back to Zach Going Fire. Today we'll be going into detail about how I invest, specifically using the 3% Signal by Jason Kelly. So, if you're new to this channel, we're going to talk about everything involving money, investing, finances. And I used to be a financial advisor, but currently I work as a truck driver. 10 years ago, my wife and I were bankrupt in 2016, and next year we plan on retiring. I'll be 44 years old. Recently, we hit $1 million in net worth, and along this path for years, we have been following Jason Kelly. Jason has written many books on finance and investing, but the primary one that we get our investing strategy from is the 3% Signal. So in this video, I'm going to do a deep dive with how that works, but I won't be able to cover everything in as much detail as he does in the book. So I highly recommend that you read the book, and I will leave a link to that below. You can also check out his website at www.jasonkelly.com. I'll also leave a link to that below. So let's get started. All right, so as I was putting together the video clips, I was realizing that this is going to be one of the longer videos that I have put out. And I wanted to just warn you ahead of time that it will be long. And it's because it deserves it. It deserves the time to really go into detail and explain how the 3-SIG system works. Now, if you're not interested in learning how the 3-SIG system works, by all means skip this video. You can read a book like The Simple Path to Wealth by J.L. Collins, and there are a lot easier ways to manage your portfolio. But I like the 3-SIG system for several reasons, and I wanted to go into that a little bit. One is that it's basically going to be similar to doing a portfolio of 80% stocks and 20% bonds and rebalancing on a regular basis. But the key differences help you to stay more in the winning part of the portfolio, whether that's stocks or bonds for the period of time. It helps you to buy low and sell high. When you just rebalance to a set amount, for example, 80/20, then you might be selling stocks more and more as they rise. And therefore you're losing out on a lot of the gains that you could have. The 3-SIG system has built-in rules to help you avoid that. So one of the things I also like about it is that it saves you a lot of time and money and stress because you only have to look at your portfolio 4 times a year just for a few minutes at the end of every quarter. It only uses 2 funds, a stock fund and a bond fund, and it can use the cheapest funds available in your 401k or IRA or your standard brokerage account. So it's also very tax efficient because you only have to do 4 trades a year. So I hope you enjoyed today's video. Make sure you stick around to the end when I will go over the 30 down, stick around rule, which is a very important rule and a major exception to the basic rules of the plan. And also, if you enjoy this kind of content, make sure that you like and subscribe. There goes midnight. Before we get into too much detail about the 3% Signal by Jason Kelly, I will also mention that we also use his 6-SIG system and 9-SIG system and income SIG system. That's right. He has developed 4 different systems, and you can use each one of them on their own or a combination of those systems like we do. But the foundation of all of these is the 3-SIG system. Its design is to get 3% return per quarter on the stock funds that you have invested. And that comes to about 12% per year. It's trying to beat the market returns, where if you look at the average market returns of about 10% a year, it's trying to beat that by a small amount. And that's all you need for long-term outperformance, just a small amount. When you start looking at other strategies that try to get more than that, then you start running into taking on too much risk and strategies that don't work for the long run. The 6% signal and 9% signal use leveraged funds. And so they are not going to work in most 401k accounts or 403b accounts. Whereas the 3-sig signal, you can use it in your 401k, 403b, and other retirement accounts. So I recommend starting with the 3-sig. The 6-sig and 9-sig also have additional rules to help manage the extra risk from taking on the leverage. So I'm not going to go into detail about those strategies. It might be a good idea to start with the 3-sig, and then if you want to read into Jason Kelly's website about his other plans and do as we do and use the different plans in your portfolio. You can split it up into a third, and a third, like 30% of your money in 3-sig, 30% in 6-sig, 30% in 9-sig, and then have a cash reserve. The cash reserve is great for an emergency or rainy day fund, or if one of the stock funds maxes out in the account, it might be a good idea to have that cash reserve on hand to add to the buying power at that time. At the end of this month will be the end of the quarter, and I will walk you through how I make the adjustments in my various accounts to match the signal plans that I follow. I'll take you step by step and show you the shares being bought and sold in my accounts to follow Jason Kelly's plans. So that will be in a upcoming video in the next few weeks as we approach the end of September. Okay, so here we have my handy dandy spreadsheet. You guys know how much I love spreadsheets, and it's just, to me, it's the easiest way to explain things regarding numbers. I'm a very visual person, and so this is how I would learn if someone were trying to teach me this system from scratch. But with the 3% signal, you're going to start with whatever balance you have. Let's say you have, we'll use round numbers to keep it easy. In your 401k, let's say you had $10,000. It could be any amount, but whatever amount you have to start with, what you're going to do is you're going to pick a stock fund and a bond fund. Just two funds to run this system. It's very simple. The stock fund that you're going to pick is going to be a small cap stock fund. Small cap being the small companies, and you want those because they are more volatile. They're going to move up and down more. And over the long run, they do tend to have a better performance than large cap companies, although not in recent years. But that's okay. We're not really trying to get a straight outperformance like you would with your typical buy and hold strategies. Instead, the 3-sig system is looking to use the volatility of the smaller companies. The more they move up and down, the more the 3-sig system can take advantage of those price swings. So the base allocation for your balance is going to be 80% in the small cap stock funds. So of the $10,000, you would put $8,000 into the small cap fund in your 401k. And then the other fund is your bond fund. You want just a general bond fund. If your 401k offers several different bond funds, it's probably you would probably want to pick the one that has the lowest expenses associated with it. So the other 20% of your $10,000 that you had would go into the bond fund. So that would be $2,000. So that's how you would initiate the plan. And you're just going to do this once per quarter. And I just have January up here just for the beginning of the year, but you could start this at any time through the year. And then you don't need to take any further action until the end of the next quarter. At the end of the quarter, you're wanting the stock fund to grow by 3%. So that would be the $8,000 times 1.03 for your 3%. You would want to have that balance of the stock fund be $8,240. Just to keep things simple in this initial example, we're going to assume that in the first quarter you run the plan that it grows by exactly 3%. So at the end of the quarter, you have this amount here. The stock and the bond funds, let's assume that it stayed at zero, grew 0%. So then your balance would be the $10,240. You wouldn't need to take any action whatsoever. So every quarter we're wanting a growth of 3% in the stock fund. On that $8,000, that would be $8,240 would be the target for the end of the quarter. So let's assume that that $8,000 in the quarter grew by 10% in the quarter. That would be an incredible quarter. But that would be 8,000 times 10%. That would give it $8,800 in the stock fund at the end of the quarter. Obviously, that's more than the target. So what we're going to do is we're going to sell some stocks to bring it down to the target. So how much do we need to sell to bring it down to that? That would be the 8,800 minus the 8,240, which is the target. We would need to sell $560 worth of stock. We would add that to the bond fund. That 560 that we're selling goes into the bonds. So it'd be, assuming bonds grew at zero, you'd have 2,560 in bonds by adding that in there. So then the stocks would be at the 8,240, the target. Okay, so just for clarity on that last example I was showing, your stock balance would be 8,240 at the end of the quarter. If you had the 10% growth in the quarter, you would sell down to the 3% target. You would add the difference into the bonds. So then your new balance would be your stocks and your bonds. Your new balance would be 10,800 at the end of the quarter. And that makes sense because you got a 10% growth in the quarter, or $800 in growth in the quarter from stocks. The end of the next quarter, what you're going to look for is another 3% growth on that stock balance, the 8,240. So at the end of the next quarter, you're looking for this times 3%. You're looking for this balance, and so on and so forth. Let's say though that the following quarter that it actually goes down. I'll go into that in the next example. All right, so from the previous example we were looking at, we ended with a balance of $10,800 in our investments. Of that, we had 8,240 in the stock fund and 2,560 in the bond fund. Over the next quarter, the 3% growth target for the stocks, we're looking to get we're looking for a balance of 84, 87, and 20 cents. Let's assume that the stocks, instead of going up for the quarter, let's assume that they go down. Let's say they drop by 5%. So that would be a loss of $412 in the stock funds. So we're going to take this and subtract that loss out. The stock funds would be down to $7,828, but we wanted them to go up to 84, 87. So we're going to take the difference between that we need another $659 to get from here to here, what we wanted, the target. So where do we get that $659? We're going to take that from the bond fund. So in the bond fund, we're going to subtract out that $659. So the new bond fund balance would be this minus this. You would sell the $659 in bonds. It would bring that balance down to $1,901. Again, just to keep things simple, that this is assuming that the bonds had no growth in the quarter. So that would be left in your bond funds. You would then add that $659 to your stock funds, which would bring it up to this. We're going to add the $659 to the $78.28 to bring it up to this. So that's the basics of how this strategy works. Every quarter we're looking for the stock portion of our account to go up by 3%. And we're making buys or sell orders based on how much it went up or down during the quarter. We only look at price. We don't look at any other indicator. We don't use our gut feelings or anything else, just the price movement of the stock fund during the quarter. Now, you may also be contributing to your retirement account or your investment account. During the quarter, you need a place for the contributions to go to. So we're going to put that into our more safe fund during the quarter, the bond fund. Let's assume that during the quarter you add an additional $5,000 into your account. So at the end of the quarter, assuming that the bond funds didn't go up or down any, you would have $7,000 in that account, in the bond fund. Now, at the end of the quarter, when you go to do your calculations, what you're going to do is take half of what you contributed, so that'd be half of the $5,000 that equals this divided by 2. That's going to give you $2,500. You're going to add that to your target for the 3% for the stock fund. So the target for that, if you started with a $10,000 balance, you would start with $8,000 in stocks. The target would be $8,000, and a 3% growth on that would be $8,240. So your new target, when you add this in, is going to be that would be your new target for your stock fund at the end of the quarter. So you would need to adjust the bond balance based on how much above or below the stocks are for this at the end of the quarter. I'll run through another example. Okay, so here's an example with real numbers from my 401k, which has a small balance. Current balance in my 401k is $1,623.44. I have $1,508.65 in the stock fund and $114.79 in the bond fund. So if we were looking at this as if it were the beginning of the quarter, we would want a growth in the stock fund from 1508.65 to 1553.91. Let's assume that during the quarter I added $300 or $100 per month. So the new target with those contributions would be 1703.91. So that's the 1553.91 plus half of that 300. Here's the equation right here. It's this 1553.91 plus half of the contributions gives you 1703.91. That's the new target. Let's say that during the quarter the stocks dropped by 7%. So we're going to take this and multiply it by 0.07. So it would have lost in value 105.61. The new value at the end of the quarter of the 1508 would be this: 1508 minus the 105.61. You would have 1,403.04 at the end of the quarter. The bonds, having added $300 and assuming that it didn't go up or down any in value, would be, I'll just put the 300 here, and the new bond value would be this plus this 300 that we added. That would be the new bond value. But of course, this isn't what we want, the 1403 in stocks. We wanted this target here. So what's the difference between this and this? Let's see. This is going to be equals this minus the 1403.04. It's a $300.87 difference. So what we're going to do is we're going to sell $300.87 from the bonds to add to the stocks. So that would be equals this minus this. So the bonds, we're selling that out. That would leave you with $113.93 in bonds. And then we're going to add it into here to give us the target, 1703.91. The new balance in the account would be the stocks plus the bonds. The new balance in the account would be 1817.84. Let me know if you have any questions. Okay, so as promised, we're going to go over the 30 down, stick around rule. So this rule kicks in place to help you stay in the market after it has dropped a significant amount. Because after a lot of times after the market drops a lot, that's when it has a big recovery, and you want to stay in the market and you don't want to be selling during that time period. So the stick around mode is triggered when the quarterly closing price of SPY, which is the ETF that follows the S&P 500, falls 30% from its quarterly closing price high within the past 2 years. Stick around means that you will ignore the next 4 sell signals. They might happen in a row, or they could be interspersed with buy signals. Either way, ignore 4 of them. You'll exit the stick around mode and resume the regular plan after you've ignored 4 sell signals or 2 years have passed. The reason for the 2 years passing clause is because sometimes the market can fall drastically and then go into another level period for a long period of time, and then it could drop again. You don't want to be stuck in that period after it has leveled off for 2 years waiting for a big recovery. You want to, in that time period, go ahead and sell some when the plan would signal for you to do so. So with the current 30 down, stick around rule, if the market were to drop 30%, or SPY were to drop 30% from its quarterly closing high over the past couple of years, that would bring it down to about 432.50, so right around this area. So this is the current S&P 500 ETF, SPY, and it would need to drop to around this area. One more rule that you need to know about is the base reset rule. We start with a base allocation of 20% in bonds and 80% in stocks, and we want to remain mostly in stocks at all times. If ever the bond balance grows to more than 30% at the end of a quarter, then we're going to reset it back down to 20%. That keeps us mostly in stocks with this plan, which is where you want to be long term. Now let's talk a little bit about performance on these investment plans. I'm on Jason Kelly's website, jasonkelly.com, and here you can see the performance of his 3 sig in green, 6 sig in orange, and 9 sig in dark blue. And this goes performance going back to January of 2016 through current, September 5th of 2025. And as you can see, the 3 sig is up 148.26%, 6 sig is up 219.58%, and 9 sig is up 1,429.83%. So let's compare that to how the market did during that time frame. I'm on Yahoo Finance now, and I've plugged in VTI, which is Vanguard's Total Stock Market Index ETF, and going back for that same time frame, it's up 231%. So if you had been invested in the stock market during this time frame here, you would have actually beaten 3 sig and 6 sig. However, it is very, very difficult to remain 100% invested in stocks during downtimes. When the market was plunging down in the pandemic of 2020, for example, it might have been very tempting to sell. That's when a lot of people panic and sell when the market is dropping a lot. And it can also be hard to remain invested when you're constantly second guessing what you're invested in and wondering whether you should be owning something else. So for those reasons, I think it was wise that I kept using the 3 sig and 6 sig plans. However, I do owe most of my wealth gain right now to the 9 sig plan. The next 10 years might be different. The 9 sig plan could be down dramatically, and 3 sig and 6 sig could be up dramatically. You never know. So going back to the Yahoo Finance, a more fair comparison might be using ticker symbol AOR. It was only up 70.73%. That AOR ticker symbol is an ETF, which is basically 60% in stocks and 40% in bonds. And that's more representative of what most investors will be in if they're not 100% in stocks all the time. So Jason Kelly's plans did beat that. And I'm happy with the performance that I've received over the last 10 years. So I really appreciate you watching, and I hope I did an okay job trying to explain how the plan works in this quick summary video. I cannot emphasize enough to read the 3% Signal by Jason Kelly. He goes into great detail about why he has each of the rules for this plan and how it compares to other plans. And he even goes into detail about how you can adjust the plan as you go into retirement to become more conservative over time. Now, since the book has come out, he has introduced other plans like the income SIG plan, which I plan on using in my retirement. And I'm currently transitioning from being 100% in his growth plans to 100% in his income SIG plan. Okay, guys, thank you for watching again. That's going to be it for today's look into the 3-SIG system. And I wanted to end with showing what my portfolio performance has been over the last 12 months, going back to September 13th, 2024. As you can see, I'm up almost 12%, which did not beat the market over the past year, but I'm okay with that because a significant portion of my portfolio is currently in bonds. And like I said earlier, I am transitioning into the income SIG system, and my current net worth should be good to help us retire next year as long as we continue to make some income as a travel agent, and we will be traveling the world. So until next time, guys, let's continue to drive towards financial freedom.